WACC, weighted average cost of capital, or just cost of capital. I'm sure you have heard some of these terms before, and you may have gotten curious as to what they mean and why any of this might be useful. Well, if you are indeed pondering about these precarious questions, you have come to the right channel and you have indeed managed to select the appropriate video, because in today's easily comprehensible video, you will learn the answer to this fairly simple yet very significant question. So, without further ado, my name is Daniel and welcome to the Greenwave. Cost of capital is a company's calculation of the minimum return a company needs to achieve in order to justify the cost of a capital project, such as purchasing new equipment or constructing a new building. It is also often referred to as a project hurdle rate. Cost of capital includes the cost of both equity and debt, weighted or proportionally accounted for according to the company's preferred or existing capital structure. So essentially, it's weighted or proportionally accounted for according to how much of the company is financed by debt versus equity. This number or percentage is known as the weighted average cost of capital, or WACC. A company's investment decisions for new projects should always generate a return that exceeds the firm's cost of capital used to finance that project. Otherwise, the project will not generate a return for investors. And if it doesn't do that, what's the point, eh? Now, let us look at the formula for calculating this magical number. First though, let's establish how we find cost of debt and cost of equity. Well, the first one is easy. Cost of debt is merely the interest rate paid by the company on its debt. However, since interest expense is tax deductible, the debt is calculated on an after-tax basis as follows. So cost of debt equals, and now we have a fraction, interest expense over the total debt. And now we multiply this by 1 minus the company's marginal tax rate. And that's how we get a company's cost of debt. Secondly, let us look at the cost of equity. Cost of equity is more complicated since the rate of return demanded by equity investors is not as clearly defined as it is by lenders. The cost of equity is approximated by the capital asset pricing model as follows. So CAPM, or cost of equity, equals risk-free rate of return plus the beta times, and now we have the brackets, and in the brackets we have the market rate of return minus the risk-free rate of return. Hopefully the visuals make it easier to understand once you see the whole equation. The beta is used in the CAPM formula to estimate risk, and the formula would require a public company's own stock beta, whereas for private companies a beta is estimated based on the average beta among a group of similar public companies. Lastly, the firm's overall cost of capital is based on the weighted average of these costs. So for example, consider an enterprise with a capital structure consisting of 70% equity and 30% debt, where its cost of equity is 10% and after-tax cost of debt is 7%. Therefore, its weighted average cost of capital would be 0.7 times 10% plus 0.3 times 7%, which gives us the weighted average cost of capital of 9.1%. This is the cost of capital that would be used to discount future cash flows from potential projects and other opportunities to estimate their net present value, NPV, and their ability to generate revenue. Since we still have some time, let's look at some real-life examples, shall we? So every industry has its own general average cost of capital. However, the numbers vary widely. Home building has a relatively high cost of capital at 6.35%, whereas in the retail grocery business it is relatively low at 1.98%. The cost of capital is also high among both biotech and pharmaceutical drug companies, steel manufacturers, internet software companies, and integrated oil and gas companies. All of these companies tend to require significant capital investment in research, development, equipment, and factories. Contrarily, among the industries with lower capital costs are money center banks, power companies, real estate investment trusts or REITs, and utilities, both general and water. Such companies may require less equipment or may benefit from very steady cash flows. And there you have it, a succinct explanation of the weighted average cost of capital. Hopefully, this video cleared it up for you at least a little bit. If you have any further questions, certainly feel free to ask them in the comments below. Additionally, if you liked the video, consider dropping a like, sharing, and subscribing for more financial content. As I mentioned previously, we are just getting started here, and there is a plethora of exciting stuff coming. So thank you very much for watching, and see you next time.